We'll see how far he goes.
Huh. I actually thought that that's what you were out at
So
the camp. Yeah.
no, well, I was checking on it on behalf of the family. The dogs were going out of their minds here too. You know how it is, Jada. If you haven't had the dogs out doing something different, they just, sometimes you can see Echo throw my elbow in the air. No. Do your dogs do that to you?
Oh, absolutely. Yeah, we had a run through last night and I had one pup on my shoulder just peeking.
On your shoulder. That's funny.
But
Luke,
we
do
did
you have
also
any pets?
Yeah, I got me or do you?
Do
Go
you
ahead,
have
Luke.
any pets, Luke?
Oh yeah. My mom has a small black cat at home. And then my dad has a miniature Jack Russell Terrier, who's I think 3 now. So
They've got a lot of personality.
absolutely. And energy.
Jaharee, do you have pets?
No, I don't. My mom was scared of dogs as a kid, but I really want to get a pit bull.
If you're scared of dogs, that's the last one I would get.
My mother was, but I'm not too scared of dogs. I think I can get used to it.
Yeah. And Dean, I'm trying to remember if you've ever mentioned a pet in your house.
Oh yes, we got 2 pets, 2 Bichon, little lap dogs. Yeah.
Do they? Yeah. Echo thinks lap dogs are like fair game. Let's just
Chew
call it
toys.
that. They're fair game.
Chew toys. Yeah.
Looks like a cat, might be a cat. Chase the cat.
All good.
Our neighbor, she moved. She was right next door to us for a while. She had a cat that stood up to Echo. Man, Echo was scared. She would tremble when this cat came by, because she never ran. She just stood her ground and put out her thorny claw and popped him on the nose. That was the end of it. That Echo was like, I'm afraid of that cat.
No, we've had pets since we've been in Houghton, and the entire time we've not gone without a pet. So
yeah, our 2 dogs are about 8 now, ish. I can look it up, but I don't. And they are starting to show wear and tear, like me.
But Janet, it was very cool though for the giving challenge date that you were able to have the dogs with you with the video.
Yeah, I definitely didn't do the Dean in a suit shot.
No, that's okay. It was great.
It was the coldest day I think I've seen in Houghton too, and I was wearing snow pants. It was a good thing, but it was so cold that day. But of course, Echo was in her element. Yeah, no, Echo was sitting outside at the camp. She was sitting outside, letting the snow just accumulate on her, on the snowbank outside the house, and didn't want to come in. So she was finally at night. I think there's wolves hanging out there, because I could see some trace, spoor, and it definitely wasn't. This wasn't bear. It wasn't. I think it was wolf scat. So I wanted to get her in, because they tend to travel in pairs, I think.
Yep.
And she might be a match for 1 wolf, but not for 2. Oh, hi, John. John says hello from wet and soggy California. So you're up there in the river, then, the atmospheric river. I'm starting to feel sorry for you, Californians. First, we were sorry that you didn't have any water. Now we're sorry you have too much water. Do you have to shovel off your house, Dean, the roof of your house?
I have in some winters just taken like the bottom third of the roof off, where you don't have to work too hard at it, just to take a little weight off. But the contractor says that I shouldn't have to, but
Makes you feel good.
makes you feel better.
But when there is rain on top of that snow, it really does add a lot of weight. All right, so we're up on the hour. Let me share my screen and get going. So welcome everybody to Husky Bites. And hang on. I don't think hang on. I gotta find my slides. Actually, I'm not even sure I need them. All right. I know where I am now. All right. Good evening, everybody. Welcome to Husky Bites. We are going to be hearing about Money Matters 2, the student strategies. And this is an extra session focused on this topic because we had a cancellation and because we also we wanted to hear a lot more from the strategy about the strategies that students use associated with investing all this money. My name is Janet Callahan. I'm Dean of the College of Engineering, and this is Husky Bites, a Michigan Technological University focused webinar. So we are about 2/3 of the way through the season. We have 3 shows left. On March 20th, we're going to be hearing about bio-inspired designs from biomedical engineering professor Bruce Lee and his graduate student. And then we're going to actually take a tour of the Seaman Museum, which is an absolutely beautiful collection of so many different things, including some of the beautiful geology of the area. And then we're going to wrap up the season with hearing from the College of Forest Resources and Environmental Science and David Flaspohler, who's going to be talking about bird watching. And then we're going to have a gap. But I did want to start mentioning that during alumni reunion, we do have a Husky Bites that we also share via Zoom. And so details on that will be posted on the Husky Bites website, mtu.edu/Husky Bites. So I just wanted to make sure you knew about that. So again, up next, it'll be Bruce Lee. He's a really interesting researcher. And with that, I'm going to stop sharing screen and you go ahead and get started. Dean, I'm going to try to stop sharing.
All right, is that good, Janet? Can you see the screen?
I can. All right, and let me just briefly, I'm going to do a real brief introduction of you, and then you can introduce the students. So it is my pleasure to be co-hosting this with Dean Johnson, who is the Dean of the College of Business. And that is my brief introduction.
Thank you, Janet. And thank you everyone for joining us with Husky Bites 2. This was kind of fortuitous, as Janet mentioned, that we had a cancellation and also that we went very long last time. So this kind of will work out. I am the Dean of the College of Business and also the founding director of the Applied Portfolio Management Program. And it's basically a student-centered program, experiential education, allowing students to maximize their experiential education by managing a portfolio of real money. And so with that, I'm going to go ahead and turn it over to the students as soon as there we go.
All right,
Jada?
well, hello. Yep, my name is Jada Hamar. Thanks for watching again. We appreciate it, or thank you for watching if you're new here. So I'm a Houghton native. I graduated this past December, and I'm still working in Houghton here at a Ameriprise Financial, just started that, so that's been awesome. So to start, same thing as we did last time, we're going to be going through a few questions. So if you have a piece of paper and pen ready, or just be ready to keep track of your answers, that would be great. So my first question is going to be, imagine that you spent $200 on a ticket to go see a concert. When you get to that concert, you pull out your wallet and you realize that you lost the ticket that you had bought. So if you want to see the concert, you need to buy another $200 ticket. Would you buy the ticket? Yes or no? So I'll give you a few seconds to ponder that. Well, I get the second question pulled up here. So once you've answered that one, the second question is, imagine you go to this concert without a ticket and you plan to buy one there. So when you get to the concert, you pull out your wallet and you realize that you have lost 2 $100 bills. Tickets to the show cost $200. In this scenario, would you buy the ticket? Yes or no? So as you answer that, we'll get to the next slide here.
So Sue, I think you have a poll question for us too.
Oh, yes.
I hope. There we go.
Yeah, so if you could just fill out what you answered for those 2 questions.
This is a very good poll.
I want to see some more people answer.
Yeah, I know. We got to get more
Mhm.
people answering. There's only, I wonder if something's wrong with the system. Because usually there would
I
be,
think I accidentally pressed stop poll.
uh-oh. Everybody, all right, Sue, start it again. And we gotta, there we go. Is it going again?
I don't know if she's able to share the results or not. Sue, are you
We
able
only
to
have-
start it again?
I don't think so.
All right.
Okay,
Oh,
We'll have
we'll
to
go
go with
ahead.
what we got.
yes, that's okay. We'll just keep going with that.
Oh,
Oh, it
it-
looks like
she
it
got it
did.
going
It's
again.
going. There we go.
Perfect. Yeah, so
All
if you guys could just fill out what your selections were, that would be appreciated.
All right, we're getting a lot of no and no's, and then the next category is yes and yes. So we're what do you call that? Bipolar or whatever?
Bimodal.
I know.
All
I
right.
answered no and yes.
Okay,
Yes, I think I'll go a tiny bit longer. We have around 70% participation at the moment.
oops.
It's fascinating psychology there.
Oh, what's happening
We'll
here?
get into that.
Are you
Oh.
guys, my computer just
Yeah.
did a whole bunch of wild stuff.
Yeah,
I know.
All right.
But while we get that presentation pulled up, it looks like we have around 70% participation, and we have 54% saying no and no, and 8% saying no and yes, 16% saying yes and no, and 22% saying yes and yes. So the reason we ask these questions is to go over the topic of mental accounting. So mental accounting is the idea that people track and coordinate, oops, got a pop up there. People track and coordinate their financial activities by partitioning money into mental accounts. So as you go through and you purchase something, you have it in that mental account. That's what that money was for. And this is done even though money is fungible, regardless of its origins or intended use, all money is the same. And this can also be shown by how people treat unexpected income differently than earnings that they expect from the paycheck. So in regards to these questions, in question 1, both $200 tickets are charged to the entertainment account in your head, which makes it seem like $400 is being spent on this ticket. And in the second question, the lost $200 is charged to the general fund account, and only the $200 spent on the ticket is charged to the entertainment account, which makes it seem like the ticket cost only $200. So you can see as you're going through these questions, even if you answered no and no or yes and yes, because maybe you're applying it differently to your own mental accounting, it does affect how you answer questions and how you spend your money. And this obviously reflects with your investments. So as you invest, you need to be aware of your own behaviors and others' behaviors in the market. So as we discussed last time with overconfidence, this time with mental accounting, it can lead to investment errors or just different investment behaviors that may not be beneficial to you. So one example of this would be holding on to losers too long. You get kind of attached to something that you purchased and you hold it open because you don't want to realize that loss, because you know in your head what you paid for it. And regardless of timing and what your portfolio looks like, you're going to hold that open so you don't have to realize that loss, and then you don't close the account until you're back above that purchase price. So in your head, that mental account of that loser is balanced before you get rid of it. So to correct this, you can kind of just make sure that you're viewing money as fungible. What you have is what you have, no matter where it's coming from or where it's going, and just try to be aware of your own mental accounting as you're doing different things.
What does fungible mean?
So fungible means that money, no matter where it's coming from, where it's going, whatever its intended purpose is, it's all the same.
Okay. I always wondered that.
Yeah. So we can go ahead to, I think I pass it off to Jaharee here.
Thanks, Jada. Hi, my name is Weah. Thank you for having me again. I am a senior and I'm graduating in the spring. I'm a finance major and I currently don't have a role lined up, but I'm interested in finance and also in athletics. So my first question for the audience, if you guys could write this down, is you have $1,000 and you have to select one of two choices. Under choice A, you have a 50% chance of gaining $1,000 and a 50% chance of gaining $0. And under choice B, you have a 100% chance of gaining $500. So write either A or B down. I'll give you a second to think about it. And then the next question is you have $2,000 and you have to select one of two choices. Under choice A, you have a 50% chance of losing $1,000 and a 50% chance of losing $0. And under choice B, you have a 100% chance of losing $500. Okay. And I think we'll have a poll too as well.
These are hard questions.
Got to make everybody think.
There we go.
All right. All right, it's I'm in the winning category here. I also chose the choice that corresponds to B and A.
Mm-hmm.
That's kind of where I
Yeah, it looks like about 50% of people are picking choice C, that's what I expected. Okay.
yeah. Huh. All right.
Cool. So about 20% of people pick choice A, which was a 50% chance of gaining. Sorry. So 20% chance of people pick choice A, and then 10% picked A and B, 50% picked B and A, and 21% picked B and B. So kind of spread out besides choice C. And so these questions created in psychology what they call a disposition effect. So the losses that you have will hurt more than your gains. And the first question was shaped in the form of a gain, but the second one was shaped in the form of a loss. So we kind of framed these questions differently, but in reality, they're identical. You had a 100% chance of ending with $1,500 either way. And you had a 50% chance of getting to $2,000 or $1,000. So the people that picked choice C were pretty logical in that they wanted a chance to gain more, but they wanted to like minimize the loss. But this leads to a potential investment error that we see, and that's focusing more on losses than actually the gains that you have. So we think about this in society as like really low risk investments, IRAs and bank saving accounts that are more focused on canceling out your losses than the gains that you can make. So in finance and in APMP, we always want to focus on both the gains that we have and also the potential losses. And then I'll pass it on.
Yeah, I was going to say, so hopefully everybody understood those two questions were exactly the same questions. One was just asking you and framing it as a gain. One was framing the question as a loss. And psychologically, the loss hurts more than the gain. You should have answered the same question the same way. Did you want the 1,500 for sure or the gamble? But when you framed it as a loss, people change their answers because losses hurt more than gains. So as a result, people are very tempted to just put all their money in savings accounts because there's no risk of loss. And by doing that, you're completely giving up huge potential gains that exist in riskier assets that could lose a little bit of money, but could make a lot of money.
Unless you invested in one of those California banks.
Well, maybe we'll get to that later tonight.
Interesting. All right, Luke's turn.
Yep. Hi, everybody. My name's Luke Helsel. I'm from Bel Air, Michigan, downstate. I'm a junior finance major, and I'm interning at Merrill Wealth Management in Houston this summer. And my question for the audience that's also on the poll is, you're looking at a firm that has beat earnings expectations for the past 8 quarters consecutively. Every single quarter for the past 8 quarters they've beaten. There is an upcoming earnings announcement for the firm, and you'd like to buy shares of this firm to bet on the positive outcome of this earnings announcement. Should you buy shares off of this information? Yes or no? I believe we got the poll up here.
Very interesting.
Yeah, 40-60, staying around there.
If you asked this in a class, Dean, what would the, by show of hands, what would they vote?
So Janet, you and I were talking about this a little bit early on. When you ask these questions, and see, by the time now we got to this question, we've triggered people's mental status. We've triggered people to start thinking very, very carefully, because they kind of got caught the first time with Jada's question, maybe got caught a little bit with Jaheree's question. So now they're starting to get a little bit. So it's really a question of, if I ask the question in my class, Janet, they would probably answer better, because they're already in that frame of mind to be on guard, to be thinking very cautiously and carefully about the question, versus thinking very quickly and off the top of their head.
And so our audience, when their answer was 60% no, 40% yes.
Very good.
Cool.
Okay, Luke, just a second here. There you go.
Oh, awesome. So this is an example of the hot hand fallacy or extrapolation bias. Those of you that answered no got the right answer, so congratulations. Most of you would have made the right choice there. The potential investment error that comes from this is you can overpay for glamour or high growth stocks by assuming that high growth rates will continue to occur far into the future. An example of this would be a tech startup that grows its earnings or grows its cash flows at 20 or 30% each quarter, beating all expectations. And the investment error would come in if you took that small sample size of data and stretched that far out into the future, assuming that high growth rate would continue to occur and the firm would continue to win. An even simpler example of this, and this is where the hot hand fallacy gets its name, is when basketball players are really making shots one after the other. People start to assume that they're going to just keep making shots, when in reality, the probability of that next shot going in really doesn't depend on past performance, especially not a small sample size data of past performance. So the correction to this is to forecast more conservative long-run growth rates and to really use more data when putting together future growth rates. And yeah, being conservative with them, kind of taking an honesty check and seeing if XYZ company can really grow at the rate that it's been growing in the recent few quarters. So I think I'm going to pass it back off to Dean here.
All right, so tonight we realized that we might have a slightly different audience than last week. So basically what we talked about last week was rational markets, and in a perfectly rational market, what would be the outcome? And we basically reviewed financial theory over time, where we came up with the idea that people are risk averse and they're going to demand a risk premium above the risk-free rate of return to hold assets that are risky. But we needed to realize that there's really two types of risks. There's risks that can be diversified away. And therefore, if you can diversify away certain amounts of risk, you should do so by choosing optimal weights. And we talked about optimization techniques, calculus, numerical search methods to solve for optimal portfolio weights to diversify and eliminate diversifiable risk. However, non-diversifiable risk is risk that exists in the economy that can't be diversified away. And what we basically have tried to do is identify models to quantify the risk premium, the extra return that you should expect to earn on assets above the risk-free rate. We've tried to identify what the sources of systematic risk are, 1 through K. It could be that there's only one source of systematic risk. Maybe there's K. Come up with measures to quantify the risk of each asset in each portfolio, which we call beta, and then quantify the reward that you get per unit of risk, which in this equation is lambda. And in a perfect rational market, there is no free lunch. The only way to earn higher returns is to increase your systematic risk exposure. You have to bear the risk to earn the return. But as we started to see in these questions that we just asked you all, The question becomes, what if people are irrational? What if markets are not efficient? Can you earn higher returns than you should be able to, given the systematic risk of the assets? Can you, i.e., beat the market? Can you earn what we call alpha, positive abnormal return? Or equivalently, as you started to hear from the students, how do you make sure that you avoid your own irrationality when you make your own investment decisions? And so that's kind of where we're going to pick back up tonight again now with the students, and let them go through and demonstrate to you the systematic approaches that the students have tried to use to develop a disciplined investment framework and to make all the investment decisions that they need to make in managing their portfolio. And again, in APMP, the students are free. They have complete discretion to come up with their own philosophy, strategy, and execute that strategy. The client for the APMP portfolio is the Michigan Tech Fund. So with that, I'm going to go ahead now and turn it back over to the students, and they're going to kind of describe to you what their teams did this year for their investment philosophies and strategies.
All right, so starting out with my team, Silver River Partners. This is a picture of the team. I believe Casey Kangas was on this the last time that you guys did Husky Bites. But here's the full team here. I've got Elijah McParland, Brett Thorne, Sarah Dax, Casey Kangas, Trent Majors, myself, and then Miles Carey, left to right there. And when we were creating our investment strategy, investment hypothesis, everything like that, we went through this, which is almost the hierarchy of investment decisions. First off, we start off with the investment objectives. This is the baseline and the foundation of what we're doing. This is really what we're trying to get after with our investments. It really shapes all of our other decisions past that. The second part is the investment philosophy, which builds on the objectives. This is how we, as a team, generate abnormal returns, or alpha, like Dean was talking about. And then implementing that philosophy takes place in the investment strategy. And within that, we'll talk about some different screening tools that we use and some different structural elements that we've got in the Silver River Partners portfolio. Finally, we are evaluated against the S&P 1500. This is how we check our performance and seeing if we've beat the market or underperformed the market. Beating would generate alpha, not beating would not generate alpha. The S&P 1500 is the 1500 largest companies in the United States. So it's a pretty high bar to have to beat, but we've done a pretty decent job so far, and I'll share that with you guys soon here. These are the investment objectives. First of all is to preserve the principal balance so that future students can help to manage this fund. We want this fund to be in continuum so that next teams in the future can also do this. In addition to that, we have an objective to generate current income to be able to meet payouts for the scholarship fund. It is a scholarship fund, being the Michigan Tech Fund, and using bonds and receiving dividend income. We'd like to generate current income through that. And then finally is to provide comparable investment returns. Again, that's comparable to the S&P 500 or the S&P 1500, which is our benchmark we compare ourselves against. We really want to make it known that we meet this benchmark or beat this benchmark. And if we didn't, there would be really not a whole lot of justification in hiring us as portfolio managers. If we didn't, why not just invest in the market? So this is our investment philosophy here. We create capital from others' mistakes. Essentially, what we look for is overreactions to market news in individual firms or sectors. So what that looks like is news will cause irrational behavior about a company or a sector, and I'll talk about a sector example once we walk through this. After that happens, usually there will be a sell-off in that sector or in that company. What we'll do then is we'll calculate the intrinsic value of a share of that company, which is the real value of either its cash flows or its earnings or its dividends. And then in addition to that, we use diversification to mitigate risk, just in case we buy into a company and we miss something on the valuation. kind of diversify our diversifiable risk away. A great example of an overreaction that I'm sure everyone's heard about right now is the bank failure out in California, Silicon Valley Bank. This has caused an entire overreaction in the financial sector, in certain firms, certain regional banks that probably are going to have some liquidity issues and may potentially be insolvent right now. But it's also causing a reaction in really high quality banks like JP Morgan that probably really don't have any structural issues with them. So that's an example of something that we may be taking advantage of pretty soon here. This is a graph of what an overreaction in the market looks like. The blue line represents the stock price per share, and then the orange line is the intrinsic value or the value of the earnings or the cash flows for that company. As you see, the blue line drops pretty aggressively there right before the end of February. And that would represent when bad news comes into the market and scares away irrational investors. These investors usually trade on momentum, or they trade on news. So whenever bad stuff comes out, they would go ahead and sell short this company and profit when stock goes down, and then maybe buy back when it starts going up. But yeah, once the news comes out, irrational investors begin selling from fear of further losses, which kind of interestingly causes further losses. And then eventually the market realizes its mistake. You'll see these red X's on this slide, and that's along the stock as it declines and as it rebounds. Because we know the intrinsic value of the company with the information that we're able to get, we can actually profit off of this and make money as the company corrects itself, as the stock price corrects itself. And then there's a small green line there. That's our take profit line. That's where we would sell our shares because we're pretty happy with what the company's done or what the stock price has done recovery wise.
Well, set, Luke.
Yeah, that's for that one. Diving a little deeper into our investment strategy, whenever we do economic analysis, we do a top-down approach. So what we'll do is we'll start off with macroeconomic data, GDP, sector growth rates, things like that. Then we'll narrow down, speaking specifically about sectors, we'll look at different sector trends. Like, for example, energy, if there's a high expectation of lower output for oil and a higher expectation for demand for oil, we'll kind of chase that down. Then we'll look into the microeconomic level. So what areas, sticking with the oil example, what areas within the oil production space in the United States are really going to be able to profit from this? And then from area, we'll go into companies and then dive a little bit deeper into that, see what high quality companies we can buy and kind of watch for overreactions from them. Our portfolio is structured in a 70-30 equity fixed income split, and there's a 5% variance on that. So 75-25 and 65-35 are acceptable based on our investment philosophy statement. We also do a core plus asset allocation. You'll see that in the equity chart on the left there. 44% of our total portfolio is built up of core stocks, core equities, but we keep 25% of our total portfolio for these overreaction moves to be able to take advantage of that and have ample cash and ample positions to be able to take advantage of those overreactions. And then we also do core sector allocation. That's how we divide up our core equities. And all of this was based on economic thesis that we've had for each sector created in the fall semester. And over time, we've started to update this as things change. As everybody knows, the market is definitely not stagnant, especially right now. As new news comes in, we rebalance these sectors as we go. But these two charts show the asset allocation and the sector allocation as of the end of December. On to the next one here. There we go. I mentioned screening at the beginning here. And these are the technical tools that we use to be able to identify when a stock is suddenly selling off or having a sudden bearish price movement. We look at four things. First of all, we look at a double moving average crossover. This is using the 25-day moving average and the 50-day moving average, which are both like the 25-day moving average is the average prices for the past 25 days of a company, and same thing with the 50-day. What we're looking for is a stock price that falls below that. Usually that signals that something has happened, and we'd like to look at that. In addition to this, we use the relative strength index, also called RSI. This has to do with the volatility of price movements. We like to see this index below 30. It is scored from 100 to 0, but it basically looks at how fast are prices changing, and are they changing fast? Are they not changing much? That all builds into that score on that index. We also use Bollinger Bands. A Bollinger Band is a line that tracks stock price. It is 2 standard deviations above and below the current price of the asset. This also looks at volatility in a little bit simpler way. What we're looking for is for the stock price to go below the lower Bollinger Band, so 2 standard deviations below that price. And finally, we look at stochastic oscillator. This is a momentum screener, again, scaled like the RSI from 100 to 0. And we use this to see how fast is something selling off or how fast is something gaining. If it's a really low value, then it's selling off very fast. If it's a really high value, then it's gaining price really fast. In addition to this, before we dive into really looking at individual companies that exhibit this behavior, we'll use a price to earnings screen from 9 to 19. This helps us nail down value companies rather than growth companies. As of right now, growth companies have been doing pretty poorly due to rising interest rates and a few other reasons. And we're really interested in getting into value companies. That's why we use that. So how have we done with this? As you see here, these are our returns from May to December. On the upside, when we're gaining in a month, we tend to beat the market not as much as when the market's down. We gain a little bit more than the market, but we lose a lot less than the market, which is good. Very low volatility. Our beta, as Dean mentioned, is quite low, which helps us maintain pretty consistent returns. But it also gives us a good opportunity to rely on our sector returns and be able to go after overreactions without really having to be too concerned with losing a ton of capital and really detrimenting the portfolio there. These are some portfolio statistics. Our alpha, which is our abnormal return, is 0.22%. Believe most hedge funds generate an alpha between 0 and 0.1%, or excuse me, yeah, 0 and 0.1%. So we're doing pretty good when it compares to all the other funds. Our beta is 0.82. For context, the market or the benchmark beta is 1. This is a measure of volatility and diversifiable risk, I believe. Dean might want to correct me on that.
The quantity of systematic risk. So we have less systematic risk in our portfolio. And in particular, as Luke is saying, we don't go down as much when the market goes down in particular.
So we're less volatile than the market. Our Sharpe ratio is quite a bit higher than the market, which essentially means for every unit of systematic risk that we take, we lose less than the market. Usually this would be a positive number, but because we've seen a lot of selling off in financial markets in the past year, especially, this is a negative number, but it's still good. For every unit of systematic risk we take, we lose less. Our returns annualized, and again, this is from May to December, so annualizing it kind of amplifies it a little bit, but we've lost 3.37% portfolio on an annualized basis, where the benchmark has lost 7.46% on an annualized basis. So we're beating the benchmark there. And as for this duration measurement, we are below the benchmark, and I'll kind of explain duration a little bit. Duration is the sensitivity of bond prices as interest rates change. As you all know, the Federal Reserve has been changing interest rates pretty aggressively this year. So it's better to have a low duration than a high duration, because it means that your bond prices are much lower in sensitivity to interest rate changes. And that's why we've been able to maintain such a good asset allocation in our bond part, or our fixed income part of our portfolio.
So Fed's increasing interest rates are going up. Everybody knows that. And when interest rates go up, bonds pay a fixed cash flow. So the only way to earn a higher return on an asset that pays a fixed cash flow is the price has to go down. And duration measures how much it goes down. And as Luke is saying, the students did a very, very, very good job of making sure that they protected themselves and lowered their duration, lowered their sensitivity to interest rates going up. It's one of the best decisions they made this year.
I think with that, I'm passing it off to Jada and Jaharee.
Yeah, thank you, Luke. So Jaharee and I are part of Portage Capital Management. Our team consisted of 2 accounting students, 1 math students, and 5 finance students. So that was fun. In the back row there, we have Anders Zarla, Marco Marquez, Keegan Irva, Bill Radiola, and then the front row, we have Chris Berard, Courtney Kangas, me, and Jaharee. So together we developed our philosophy statement and strategy to present to the APMP board, which is our client, and executed this strategy. So we started with our given objectives that Luke went over and worked as a team to develop this. And we decided on taking a contrarian approach to equity investing. A quick definition of contrarian investing is purchasing and selling in contrast to prevailing market sentiment of the time. So a big part of this is being aware of the herd mentality bias. So this refers to investors' tendencies to follow and copy what other investors are doing. So investors are largely influenced by emotion, and this leads to overreactions in the markets and everyone following what everyone else is doing. So we kind of wanted to be aware of that and see how we could take advantage of that in our own portfolio. So that when this happens, assets become overvalued, and assets that are sold to chase the trend become available at a discount. So there's opportunities at both ends. So this is achieved by using long-term investment horizons and choosing companies with strong financial fundamentals and extensive market research. So we aim to differentiate from the market trends and carry this through our diversification, our sector allocation, and asset selection. So it's not just going against the crowd, it's doing it with reason and background information and making sure that we're making right decisions. So we set our asset allocation a little bit aggressively. We had a goal of 70% equity and 30% fixed income, and we actually allowed a variation of 10% to make sure that we could execute our philosophy and strategy effectively. So as you can see, for our fixed income, we wanted to structure this a little bit differently. We recognize that there weren't many contrarian opportunities in the fixed income. So for our fixed income, we wanted to structure this with a laddered approach. So as you see from the graphic, this is done through different bond ETFs with durations that closely match the benchmark. So we stagger these ETFs across different maturity dates to obtain ongoing cash flows while managing our reinvestment risk and managing interest rates. So the fixed income approach is mainly for our diversification and aided in our tactical allocation as well. So we had this was kind of a strong level of our execution in kind of being a more stable portion of our portfolio as we went with our asset selection for our equities. Our primary screening we used was the dividend adjusted PEG ratio, which is price to earning and growth ratio. So this focused on companies' price, earnings, and growth. And we really looked for, as Luke mentioned, value stocks. So companies that were going against the trend, and maybe one indicator would be a 52-week low. So their stock price is low for 52 weeks straight. This would kind of trigger our primary screening. And as we look at this company, this is where the secondary screening comes in. And we really look at the company and what are their fundamentals, what is going on, what's their free cash flow to the firm. So this kind of focuses on companies that would use their excess cash flow in ways that are pro-investor. So firms can pay additional dividends, repurchase stock shares, fund acquisitions, or simply just reinvest the extra capital back into the firm. So we're really looking at the firm at the primary level to see what's going on within the firm. Is this a good company to invest in? Will it benefit our portfolio? And another aspect of the secondary screen would be the operating margin. So that at this level, we would compare it to the current industry medians for operating margin. How are they doing compared to different firms within this sector and industry? And because it is very industry specific, we would look at this while we do our buy reports for specific buys or sells.
Okay, so the most important part about what we're doing in investing is bringing positive return and showing our performance. So this is our returns from May to December, and it's different from Luke's team's returns because it isn't annualized and it's just showing them like as they are. And we kind of, what Jada was talking about earlier with mental accounting, there's examples where our team would have losses and we might not necessarily address those losses at that time and might hold on to those losses. And it's hard to know that like our team's on we have short-term losses, but our philosophy and our strategy is based long-term, and we want to base like, we don't want to necessarily overreact to like certain losses. And our total return, as you can see, is negative 2.25%, which was a little better than the benchmark, but when we lost, we were less volatile and we didn't lose as much as the benchmark did.
Yeah, so one thing I want to point out to the audience, maybe Janet, would be is that the APMP students do this for a year long, but they understand that they're managing this money for the Michigan Tech Endowment Fund. And so as Jaharee is saying, is even though they're only in the program for the 1 year, they don't want to panic or make transactions and trades and try to have a 1-year investment horizon in managing this money. So I really have appreciated the students having the long-term strategy of managing this money, even though they're in the program for 1 year, and not panicking, for example, with losses and or becoming too aggressive with their risk exposure because they only get to manage the money for the 1 year.
Well, I mean, I told you it a couple weeks ago. I hardly ever try to log in and look at what's going on with my own retirement portfolio, but I'm down 7. I think 7. It was 7-ish%, and so I quickly logged off without doing anything, which is the right thing to do, right?
Well, you were average, so that's not bad.
So you guys are, I would have lost less money with you guys, right?
You would have.
Yes. So these are a couple of our portfolio statistics. Our alpha, which is the excess return earned above the benchmark, was 0.1, and our beta was 0.85, which was the risk that we had. So our risk was a little lower than the benchmark. Another statistic that we had was our information ratio, and this is the portfolio returns compared to the benchmark with volatility and risk adjusted taken into consideration. So the information ratio kind of compares the performance of specific fund managers or managers to each other, and that's why it's risk adjusted. And this information ratio was 1.93, so it could see a little bit of improvement. And our duration was 2.34. So as Luke was saying earlier, interest rates over the last year have been rising a lot, and that would, since our portfolio duration's lower than the benchmark, it allows us to be less volatile in terms of our fixed income and our bonds.
And one thing I forgot to mention with Luke's slide too, and this slide, is that this is monthly data. So in other words, when they are telling you the alpha is 0.1%, that's 0.1% per month. So if you compound 0.1% and annualize it, now we're talking, over a full percentage point of extra abnormal return, extra return above what their fair return was for their beta, for their systematic risk that they took. They're generating abnormal return. They're beating the market. They're performing better than the rational financial models predict they should be able to do. So that's what that alpha is telling us. And again, that's a monthly statistic, 0.1% per month of abnormal return.
Thank you, Dean. And with that being said, we'll be open to questions.
I want to clap because I've heard more vocabulary words that I haven't understood, you know, in the past hour than I've probably heard all year long. And I know a lot of words. I'm just like, wow, they really know what this stuff means. It
So Janet,
inspires
you
me.
know, yeah, so Janet, it's a really unique thing to be in finance. There's lots of different things that you can do. You can be very much a quant finance person and do statistics and calculus and optimization and be very math quantitative oriented. You also need to be client facing and be able to be salesman and personable and oral and written presentation skills. You need accounting, you need economics, you need business. It's a very, you know, unique blend of, and again, at Michigan Tech, that's why we really like having a finance program here at Michigan Tech, where our students are interacting with all kinds of STEM students. And so computer programming, engineering, calculus, you know, technology innovations, and then at the same time, they can get the accounting, economics, and the business education. It's a very, all these skill sets accumulate to build into potential different paths in finance and investments.
Yeah. Well, so here's a question for each of you to give an estimate on. So how many hours per day or per week are you spending in analysis and management? So you probably have weekly meetings as a team, I'm guessing. And then do you meet with your client every week too? Or is that kind of like once and done for the year?
So I could probably answer a little bit of that question. So the team meets more often in the beginning, in the fall, and then in the winter. So the team meets with the board every once in a while in the fall, winter, and spring, but like individually we meet more often when we're going to present to the board. But I would say each team meets about once a week to discuss different opportunities that they might have, or discuss like buy reports and what like we're thinking about voting on. Because when we have a business decision or a decision to buy or sell, all the members have to be there to vote on it.
And that's above and beyond the classroom. We have, you know, the 3 hours in the classroom every week.
And so I'm looking at your slide with your team. So it looks like there's about sort of 7 or 8 people on each team or something like that. So are each of you kind of looking at what's going on and bringing an idea to each weekly meeting?
Yeah, so we're kind of all doing work and we're all presenting it to each other, especially in the development phase when we're developing our investment philosophies and strategies. We're spending many hours together discussing what we think, because obviously working with a team, we don't all think the same way. So it's a really good team building right from the start, kind of getting that initial foundation. And then from there, as we meet, we kind of work together and we make decisions together, and we all conduct our own buy reports, and then we present it to our team and discuss it, whether we all agree with the person or if we have to discuss it more before we make a decision.
Do you have anything to add?
In talking to alums years later, Janet, they talk about that the teamwork and the professional communication, the professionalism, interacting with the client, they might start to forget about the buy reports and how to do their financial evaluations, but that's what they take with them for a lifetime. But go ahead, Jaharee or Luke, you were going to say something?
Yeah, I was just going to add that in my team, we have people divvied up to watch all 11 sectors within the market. And at our weekly meetings, we go through each of them and see, you know, if there was something big that happened in them or something good or bad, whatever it is. And that, I mean, for me to give some of my weeks, it's been about an hour or 2 of research above and beyond, like Dean was saying, with the classroom. And then also if we have a buy reports, if we have a buy report that we're doing, that can take 5 to 6 hours to really iron it out and make it really, really clean. So it's a lot of dedication outside of the classroom, and it's really satisfying too. It's a good time.
So Janet, I see a few questions here. If you don't mind me jumping on a couple of the questions,
Yeah,
and I can turn it over to the
absolutely.
students. Yes, we've had lots of student athletes in the program, hockey players, just a ton of different athletes in the program. We also, though, again, we formed teams. Some other people ask me how many teams there are. This year, there's 3 teams. We'd like to have teams of 7. That way, there's a no tie votes. So this year there was 3 teams. You only got to hear from 2 of them tonight. And when we put the teams together, I think, was it Luke or someone, they're not cookie cutters. We have bioengineers, we've had, forestry students, accountants, economics. It's a mixture. We want a team because that's what's going to be like in the real world. We divide up the money equally. So this year with 3 teams, we gave each of the teams around $700,000 to start with. But if there's 2 teams, then they'll get $1 million apiece. One of the people asked about ESG, environmental, social, and governance factors, whether or not we take those into account. And that kind of goes back to the philosophy of APMP. It's up to the students to decide their philosophy and strategy. So the answer is they could, or they might not, depending on their individual choice. So I don't know if you guys want to talk about ESG, whether or not you did that at all this year.
Yeah, with our finance allocation, we looked at different companies that were updating to become more ESG compliant, just to see, as they come and get more ESG compliant, we could gain value in those shares. But it's not really something that we look at when we evaluate a company. We're more looking at the earnings and the free cash flow rather than that.
What about,
Yeah.
Oh, go ahead, Jada.
Yeah, I was just going to say for our team, when we were developing our philosophy, we did discuss it, but it wasn't something that we implemented in our philosophy by the time we got to the fully developed philosophy and strategy. So it's something that comes up in our discussions, but it's not defined by our strategy per se.
I see one question was, do you guys start with cash each year, or do you guys inherit the previous year's portfolio?
So we inherit the previous year's portfolio, and sometimes it gets kind of confusing because last year there was 1 team and this year there was 3 teams, so they had to split it up 3 different ways, and yeah, it can get a little bit confusing.
Yeah, this really tested our problem solving skills. We did have to make sure that we were communicating with the other teams and all on the same page on whose was what. And then from there, as we implemented our strategy, we did have to develop the portfolio from how we got it and what we wanted it to look like. So that was another development that working through as a team, like, this is what we're starting with. How can we make this better as we apply our philosophy and strategy?
So another question here is, what about taxes, capital gains and taxes? Do you guys have to take that into account?
No, we don't, because APMP is a nonprofit, and so we don't have to pay taxes. Actually, we're tax exempt.
Good question.
Yes, and so in fact, that actually allows the students to actually have an advantage. Their relative advantages is that if they buy taxable assets, they don't have to pay taxes on them. So when you think about taxable bonds versus tax exempt bonds, we don't want to be buying tax exempt bonds because we're already tax exempt. So they take that into account when they look at their client. That's part of that. Luke talked about the client, understanding the client, and that's part of it.
So
Go ahead.
I was going to say, so, your portfolio is kind of, you have to calculate it to see kind of where you are. You're running a lot of calculations because the entire portfolio is the result of all 3 of your teams, right?
Correct, but tonight, Janet, they each presented just the results of just their own standalone
yeah.
portfolio.
Okay.
So we actually have a third of the portfolio that we didn't present tonight for results.
Well, in a way, you're even more diversified, right? Because you've got these 3 teams approaching the problem. It's interesting.
Yeah, and our point of it was, Janet, that we're raising the money from alums, donors that donated the money explicitly for this. Some donors said, I wanted the money to go for scholarships, but I want the students to manage it. Other donors donated the money for the program. And the whole purpose of the Michigan Tech Fund is to support the education of the students. And so normally the Tech Fund pays out money to the university to support the students' education. And this is just a win-win. The students are getting the educational benefit of managing the money and the returns are going to support the students. So the students will be heading, Luke, where are you guys heading next month or next week, 2 weeks from now?
New York City.
For the conference. Jada, what advice would you give current college kids about in making investments?
I love this question. So I guess my first advice would just be to start young. Don't put it off until you're out of college. I'll just wait till I get my first job. Really, time is on your side when you're starting young. The most beneficial thing you can do. And if you're not sure on how to get started, I would really just do your research, try to be aware of your own mental accounting, how you're treating your own money, how you're living budget-wise and putting money away, and also just ask for help. There's so many resources, even at Michigan Tech. Like if you're a Michigan Tech student and you're wanting to get started, go talk to an APMP student and ask for some advice, or talk to a professor, or even your parents. Like ask your parents, did they start young? Do they have regrets about not starting young? Kind of just using resources that you have around you can be super, super beneficial as you get started.
So Jada, would you like to tie into, there's a question about, does Michigan Tech have an investment club for students? Would you want to talk about the finance club a little bit? Or Luke?
Yeah,
or Jaharee?
so yeah, I was just going to say, we do have a finance club and it's open to any students. They meet once a week. I believe Tuesday nights is when they meet. Can't really remember, but that is a super beneficial place where you can just, they discuss current finance news and what's happening, and you can get really good advice. And it's just a really good group of students that you can learn a lot from and learn with.
All right, so I'm going to be a Michigan Tech alum with $1 million in the bank, and I'm 70 years old, and I think I'm going to live until I'm 85. How should I invest my $1 million?
So Jen, I'll start a little bit, but I just want you guys to go back to what Luke said, that base of the pyramid, understand the client. So what you're starting to tell me is, here's my, here's where I'm at. I've got 15 years, but we'd want to know some more information. For instance, if you're spending, if you can survive just on your Social Security and this is just extra money, then we could afford to be a little bit more aggressive with you. If this is money that you're desperately living on every single paycheck to paycheck, so to speak, retirement paycheck, then we'd have to be a little bit more conservative. So what that would probably do is the very first thing Luke started talking about in all of them is they talked about their asset allocation. That's that 70-30, whatever that split would be. They'd have to tone that down for you to, depending on how you answered that question, is this $1 million critical or is this kind of extra money? And that would make them adjust based on that client. But in the end, then they still, for their active portfolio management, they could still be actively trying to manage that money using some of these same strategies that they, already discussed about based on their philosophy.
Okay, all right. That good to know. Good to know. There's a couple more questions. Why don't we take one, let's say 2 or 3 more questions, Dean, and then we're gonna wrap it up.
Sure. So Jaharee, do you guys invest in annuities?
Sorry, I was looking at the question that was saying about the independent holdings of any team.
Oh, okay. I'm sorry. So the answer is we don't.
No.
Sorry, I did that to you, Jaharee. We don't invest in annuities. Annuities are basically a structured product. I would tell you that annuities are appropriate for some people, but they're appropriate for people that are very, very risk averse. Remember me talking about, or we talked about the phenomenon that people get so focused on avoiding any potential loss that they give up and don't realize they're giving up and sacrificing big potential gains in the stock market. And annuities kind of appeal to people that are in that situation. And it could be that the annuity is appropriate for you where you're at in life, but I hate to say this, in some cases, people are buying annuities because they're suffering from that behavioral psychological mistake that they're so focused on safety that they're not, avoiding any potential loss, that they're giving up the returns by directly owning stocks.
Thanks, Dean. So I saw a question said that said, do the 3 independent teams have any of the same holdings? There was a lot of groups of ETFs and sector ETFs that the team last year had, and those were split up. So I would say mainly sector ETFs are common between each of the teams, but the amounts and of how much are kind of like specific to what each team wants to do with their strategy and philosophy.
I think we're actually caught up on questions. I think I would love to have each of you give us a one-sentence piece of advice to do with our portfolio, or just a comment about the weather. And so I'm going to start. Thank you, everybody, for joining us. And I think I'm going to be looking you up, Jada, for some personal advice. You're going to have to send me your cell phone number or something. All right, Jada, you go next.
Well, thank you everyone that took the time to watch that. Really appreciate it. And I guess my one sentence of advice, I guess my topic mostly focused on behavioral finance. So just be aware of the decisions you're making and the why before you do them, whether it's overconfidence or mental accounting or whatever else. Just, yeah, that would be my sentence of advice.
Jaharee, why don't you go next?
Sure. Thank you very much, everybody, for listening. I appreciate you guys being here. My piece of advice would be, don't be afraid of losing. Don't be afraid of the loss that you might have. And the potential gain could be more than you imagine.
Very good. Luke, you're up.
Thanks again for everybody coming. This has been great. Glad you guys were able to hear what we had to say here. And my, I guess, investing piece of advice was to never forget why you bought something, and don't act irrationally when the waves of news come in and stir things up.
Okay, I won't. I'll just log off quickly. All right, Dean, why don't you close us out?
Yeah, no, I appreciate everybody's time, and I hope for all of us here at Michigan Tech and Michigan Tech alums that, this is just one example of experiential education that's been going on at Michigan Tech for a long time. And, it's a great opportunity for the business college students to do this, but it's just an example from Baja to Clean Snowmobile to all the enterprises. And we really appreciate the support of all the alums to, support these students, help them find jobs. So I'm not going to give any investment advice. I'm just going to tell everybody, be a proud Husky.
Go Huskies. All right. Good night, everybody. And thank you again.